And I'm so excited. Whoops, LinkedIn says you are not approved. Okay, let's remove and save changes. And I just want to make sure that I am live. Yes. Okay, so I'm live on Facebook, which is great. I just need to make sure the other portion of this is live as well. And then we are good to go. Yes, we are live. Okay, so we are live. I'm broadcasting on 3 platforms. So excuse me if I'm not going to look at the camera at all times, because the reason for that is that I'm looking at multiple cameras, and that's just because I am broadcasting on multiple platforms. So excuse me for that. This is my first broadcast that I've ever done, and I thought it'd be vital that I do it and not waste too much time after what has happened, after the crash that we had in the stock market. I thought it's very important to discuss where real estate is going and what my thoughts on real estate are, and how I see the economy moving forward. So I'm live, DJ David. I am live on YouTube, and I'm also live on Facebook. So those are the other platforms that I'm live on. I think if you want the most coverage and the most light, YouTube would definitely be where you want to watch me. But that being said, I am live on TikTok, YouTube, and Facebook. So excuse me if I don't look at the camera. I am still talking to all of you. For anybody who can't hear me or can hear me, um, or is having issues, just let me know, and I will try to adjust everything in a timely fashion. Cool. All right. So, Mr. Rolex 36, I am talking to another camera that I have set up for this live. And we are going to discuss the future of real estate in 2020 on a Saturday night. I'm just waiting for a couple of people to log in on the YouTube platform, and then we should be, for the most part, good to go. I'm just waiting. Okay, I think we have enough people to where I can start talking, and we can talk real estate. So for those of you who don't know who I am, who don't know what I do, I post a lot of car content, and I post a lot of different things on YouTube all the time as far as my content. But my name is Hamza Ali, and I am a real estate investor. I'm based out of Houston, Texas, and I mainly invest in multifamily real estate. I also do a lot of commercial real estate development. And I have completed, so by completed, I mean like full turnaround, 3 funds in the past 6 years. And I'm currently active in about, I want to say 5 funds. And total value of all the funds put together is around $60 million. So that is kind of where I'm sitting at right now when it comes to my real estate portfolio. So I consider myself to be at least knowledgeable. I've also, by the way, sorry, I skipped out on a few things. I've also helped take a company public, and that would be a REIT. So I've also helped form a REIT, set up a REIT, and I've also helped in other matters and served as legal counsel, or not legal counsel, sorry, served as general counsel on other matters when it comes to real estate. So I really wanted to discuss where I see real estate going and what I see happening moving forward, as this pandemic has accelerated quite a few things for everybody who's interested in investing in real estate, or everybody who has already invested in real estate. The stock market, the Nasdaq, especially took a big hit just before the weekend. So I think it was the second and the third was really when the Nasdaq took a beating, and we saw stocks like Tesla drop from 510 all the way to 390. I believe Tesla is still sitting at 390. There's a lot of different reasons. I don't think this was a correction. I do think this was a shift in money. So money was shifting out of certain sectors and moving into other sectors, and there was a lot of profit taking that went on in the market. So I really think that it's not time to really panic. It's always time to panic, actually, because when we have a sell-off, everybody is selling off. But I don't think it is the time to panic in a big way right now. I think there will be a minor correction, which was anticipated, which was expected. And then I think that will be kind of resolved, and we are going to see momentum in the market. So for those of you who are in the stock market, just, hold your assets for a little longer and you should be okay. And for those of you who in real estate, I think you guys are actually already um, on the recovery side of things, as life kind of goes back to normal in certain states. Of course, I don't have input on all states. I'm based out of Houston, Texas, so I will mainly be talking about states that are similar to Texas as far as opening up and things getting back to kind of like the new normal. Before I get into today's video, what I wanted to talk about is a little bit about the interest rates and what role interest rates play in real estate acquisitions. As you all know, interest rates have dropped quite a bit over the past few years, actually. So I've seen interest rates drop, quite a bit over the past few years. And when I say past few years, I mean about 2 years now. We've seen interest rates dropping, and we have seen a lot of downward momentum. So which means we have seen a lot of pressure, which is why interest rates are dropping. The current climate calls for lower interest rates so that people can remain in the market, so that the economy can remain stimulated. Now, the government calls this stimulus. You could also look at it as manipulation. This is the government manipulating the economy so that things keep moving forward in a positive motion. We have an election year, which is very vital. It's a very important election year. And regardless of which side you're on, the economy will continue until at least election day to ride, because one party wants to defend and the other party wants to attack. Now, after election day, that may change, but it'll still be the same, where one party will want to defend and the other one will want to attack. So I don't really focus on too much news. I'm not interested in what the media has to say. I just look at technicals. I look at verticals. When we invest in a certain market in real estate, we like to look at technicals and verticals and do our research before entering, because politics will always be there. And it's just noise that kind of hinders our ability to make decisions faster. So with that being said, I wanted to go ahead and talk a little bit about interest rates and why we are where we are and what's going to happen next, I think, in my personal opinion, with interest rates. And I would like feedback from you guys. So if any of you are in the chat, go ahead, give me some feedback. If you guys think or you have anything to say, I'm listening, and I'm here for you guys. Like I said, I may turn my head, look at a different screen for a little bit, and then come back and then look at my main screen, which is you guys over there. Interest rates are at historical lows, and I think what we need to understand, or what we need to see, is we need to actually look at the situation from a macro level, meaning from an international level. So once we do that and we kind of zoom out of the United States is a huge economy, but you have to realize that it is not the only economy in the world, right? We play with the rest of the world on this playing field, right? And we have to understand that the rest of the world is also very important to what happens. And our currency, our fiat currency, needs to remain at a certain level in order for us to do business with the rest of the world. Now, with that being said, when you zoom out and you look at the world at a macro level, what you will see and notice is that we are probably one of the only economies with a positive interest rate today. And I don't think that interest rate can go any higher. And that is just because most or rest of the world right now is in downward pressure, and we are seeing negative interest rates all around the world. And what that means is when you put money in the bank, you actually don't make any money. For those of you who are just listening in for the first time, what that means is, imagine putting money in the bank and then losing money every year on that money that you're putting. And that is after inflation. So of course, if you had, for example, if you had $1,000 in the bank and inflation is at 5%, what ends up happening is that you lose that 5% automatically every year, even though your bank account still says you have $1,000, just because things get more expensive. Inflation is calculated in different ways in different countries. And what you get to see is you get to see uh, your money becoming less and less value, which is why they say the rich get richer and the poor get poorer, right? Because the rich invest uh, where the poor don't have access to these some of these investments, or are not sophisticated enough to invest in the public markets. Um, that being said, that's just a saying. Those things are changing, of course, now with technology and with people having access to the internet and being able to find, opportunities, whether they are small business opportunities or large, or be part of a larger business opportunity. Um, and I think it's very interesting times that this is happening. But when you look at it from a macro level, I would say we are one of probably the only nations um, that have a positive interest rate. Now, what does that mean, right? I think at this point, what we've heard from government is that they are thinking, or they are looking at dropping interest rates if need be. Um, they are looking at stimulating or manipulating the economy if there is ever a need to do that. And the reason that they're interested in doing that is, of course, they want to keep the economy thriving. They want to keep the economy moving, and they want upward momentum in the public markets and in other markets as well. Now, but that being said, real estate is a whole different animal. So before I talk any further, what I want you guys to understand is that real estate is a a different animal and has been through, yes, this is what I wanted to tell you guys. Real estate has been through a huge change over the past 3 years and when I say that, I'm not talking about investing in real estate, getting your rent, and becoming a landlord, or mailbox money, or investing in somebody else's asset. What I'm talking about is the laws and the regulations that have changed in real estate, and they have huge tax benefits. So I want you guys to think about this for a second, right? I want you guys to just think about if you were investing in real estate today and you were not making any money at all. So meaning you had cash flow, you had tenants in your assets, um, and real estate is just. I'm sorry, I just keep getting a lot of text, so I'm a little distracted. But what's happening is that real estate has many advantages, and I want to go over some of these advantages, uh, and and I want to explain exactly why these advantages are so important and why people should be investing in real estate. Um, and it's just very simple, right? So I'm going to go over just the one main basic advantage, the tax benefit. And of course, there are multiple advantages. There are many advantages. There's 4 advantages that I preach about investing in real estate, and those are the reasons that I I talk about real estate. But the main thing that I want to discuss today is the tax advantage of real estate. And over the past 3 years, the tax laws have changed around investing in real estate. And specifically, what I'm talking about is depreciation. So depreciation is a very important element in real estate investing. And there's a lot of people who invest in real estate to offset other gains or to offset other incomes. And that's just something that we kind of have to understand. Uh, and and those rules, right, have changed over the past 3 years to where now you can depreciate real estate much quicker. You can probably take the tax write-off up front. And what that means is, let me give you guys a basic example. And what that means is, if you bought, let me give you an example with a car. If you buy a brand new car and you drive it out of the dealership, the minute you drive it out, that car depreciates in value. And it could depreciate anywhere from, between 5 to 10% on that day. The minute you drove that car out, it lost 10% of that, its value. Now, when you lose 10% of a car's value, let's imagine your car was a business. That means you took a loss. Now, you didn't really take a loss because you paid for that car and you drove it out. You didn't really take a loss until you sell, right? But you did take a loss on paper, which means that the car depreciated in value. You took a hit on paper, and I'm sorry if I'm unable to focus all around. It's just because I have multiple monitors and I have to just keep checking all the chats. Usually I'm a very good thing. It's just this broadcast is the first time I'm doing it. So anyways, so let me try to zone in on just one camera, right? So if you had a car and it depreciated in value, that means you took a loss. Let's say you bought the car for $100,000. Now what's ending up happening is you're probably going to take a 10% loss, so your car is now worth $90,000. That 10% loss you are able to call a loss and then use that as a loss, and then anytime you have a gain, anytime you have a gain of similar amount, what will happen is it'll just end up zeroing out. So you lost 10,000 here, you gained 10,000 here. That means you made $0 for 2020. And with real estate, what you were able to do is you were able to depreciate real estate over 27 and a half years. And so 27 and a half years, you buy a piece of property, every year you take a loss on it because it depreciates over 27 and a half years. That number changed a few years ago for us. That number became around, I would say we averaged it out to 9 years. So every time you bought a piece of property, it went to zero value in 9 years, meaning every year automatically, without you doing anything, you took a huge loss on that piece of property. And what ends up happening is a lot of people make a lot of money in a lot of different ways, whether it's through their profession, through their careers, through their businesses, right? And they need something to offset those gains. They need things, assets that will depreciate. And a lot of people invest in real estate. And I'm talking about all the way from the top. So you're talking $1 billion investments all the way down to, your everyday real estate investor who needs a little bit of a loss on his portfolio. The best thing is that the real estate doesn't really depreciate, but because of the loophole that's created with the IRS, and the rich are heavily invested in real estate, what ends up happening is that you are now able to offset millions of dollars in gains and turn them into losses in a very short amount of time. So when you invest in real estate, you can now take all your losses upfront by a process called cost segregation. And you guys might want to write this down: cost segregation, right? Cost segregation is an amazing, phenomenal tool that every fund, no matter how big it is or how small it is, use. I actually also recently found out that you can cost segregate individual homes. So for those of you who are interested in just investing in homes, not being part of a fund, not investing with other people, just investing yourselves actively, I think it's a great idea for you to look into cost segregation. And of course, at a larger asset level, cost segregation is very expensive to do. But from what I hear and from what other investors have told me, cost segregation will cost you around $400 per home and will offset 100%, almost 100% of the home's value in year one. So let's say, for example, you purchase that home for $100,000. Well, there's no real $100,000 home anymore. Let's say it was $300,000 here in Houston, Texas. You could use this process and you could use cost segregation and offset that entire $300,000 over 9 years, but you could take that deduction upfront. So year one, you could offset the amount that you invested in the property. sometimes what ends up happening is that the ratios differ, and I want to make this very clear. Cost segregation doesn't mean that you can offset 100% of every property every time. There's a study that people do, and based on that study, and based on the expenses that you will incur, cost segregation works based on that study. So you have to hire a cost segregation firm that'll come and do a study, and they will issue a report. Sometimes this report is in your favor, meaning they offset a lot of things, just because the way they do it is like they look at each light bulb, they look at like your washer dryer system, they look at each fixture in the house and how quickly that'll wear and tear. They look at your fridges, they look at your electronics. There's a lot of things that they end up looking at, and this process has really helped us offset, and actually I would say pay no taxes for all the real estate that we own. And I have a fairly large portfolio, so I'm imagining people who are higher up and below down are able to offset all their gains, all their realized gains through the cost segregation process. And what this does is, when you have such a heavy loss, like let's say, for example, I cost segregated a $10 million asset and got a $5 million, or well, not five, let's say I got a $3 million loss in 2020. That means I'm allowed to make $3 million somewhere else and not pay any tax on it. Once again, I'm not an accountant. I'm not a CPA. So please discuss this with your CPA if you're interested in investing in real estate and you want to find out what the depreciation process is. A lot of CPAs actually don't even know about this. A lot of them do, of course, but a lot of them don't. So make sure that the CPA you guys use is a real estate professional and he understands the cost segregation process, and he has actually done cost segregations in the past. There's a lot of CPAs that will understand the process but have not executed on a cost segregation in the past, and you want somebody who has executed on a cost seg. We call it cost seg in our industry, just so that they get their numbers right. You don't want them doing something wrong and then you missing out on an opportunity where you could have taken a bigger loss. So far we covered interest rates, and we covered the advantages, the tax advantages of investing in real estate, right? Interest rates are at record low. Tax advantages are basically at record high. Now, as we got into 2020, I actually purchased an asset. So it was the only asset that I ended up buying in 2020, and I have not been able to buy anything since then, and I want to get into that. But before I get into that, into investing in larger commercial fund type deals, I want to first talk about your single family homes. I think right now, single family homes are probably at the strongest, there is at the highest demand. And there's two reasons for that, right? The first reason is the pandemic. Of course, we have the pandemic to thank for a lot of things. But what the pandemic has done, it has taken people who live in very tight spaces, and it has opened their eyes now to moving a little bit outside to the burbs or a little bit outside their neighborhood to where they want to buy homes. And what the homes do is the homes give them space, right? So imagine a family of four, husband, wife, two children, and everybody's cramped up in an apartment 24 hours a day. Everybody's working from home, studying from home. Of course, the kids now have started school, but most of the schooling is also from home. So everybody's at home 24/7. These apartments are being used and utilized like crazy. They weren't being utilized like this before, which means the apartments are getting run down, but that's something I'm going to discuss a little later on. Right now, what I want to discuss is the single family home market. What's happening is people are realizing that, hey, we're pretty tight and we're stuck here and we don't want to be in each other's faces all the time. So what we're going to do is we're going to move out to the burbs and we're going to buy homes. And what is helping them is the low interest rates that we have. Single family homes have taken advantage of the low interest rates, meaning they have directly benefited from these low interest rates because those interest rates are being passed down to these individuals. That is not the case in all the other asset classes, right? So now single family home is really where people can take advantage. It is the hottest asset. Closings are at record high. Loans are relatively easily available still. So it's not like 2008 where there's no liquidity in the market, meaning there's no people lending, right? You still have a wide range of lenders. I will tell you this, that lending had become very strict and very tight a few months ago. So if you were in March and April, any home that fell into the jumbo loan, process, which was over the $500,000 home, was difficult to close, and understandably so. Of course, Fannie Mae and Freddie Mac were both worried. They didn't know how the economy was going to look. They didn't know what job loss was going to look like. They didn't know what unemployment was going to look like. So that meant higher risk, which means by default, which means lower closing rates, right? And this actually affected the commercial real estate space as well, which I will get to later on in the video. Now, what I want to talk about is single family homes. The demand has gone up. The demand has gone up so significantly, and the interest rates have helped a lot of people buy homes. And when I say buy homes, let me just give you guys a small example on what I mean. What I mean is when you had people, for example, let's talk about the national average of the mortgage, right? What is it, $1,600? I believe that is the national average on the mortgages. With $1,600 in the past, you could get around $200,000 in debt, which means you could buy a $300,000 home or similar, right? Or maybe just a little less than 300,000. Put 20% down and able to get a loan at 4 or 5%. Now with the 2%, if you calculate that over the 30-year, you are now able to buy a home that is like $320,000. So you're able to buy more home for the same amount of money just because interest rates have gone down. And this is what a lot of people are doing. People are comfortable paying $1,600 to $2,000 for a mortgage, and they are able to buy a bigger home. And so this is kind of where everybody is going. And this is the direction that people are taking. People who are first-time homeowners are able to buy more house for the same amount of money. People who are existing owners are able to take out money and keep more money in their pocket, making their payments significantly smaller. So the single-family market has become one of the strongest asset classes, just in the real estate space as a whole. Now, unfortunately, single family is very good for people who are looking to invest in 1, 2, 3, maybe 4 deals, 4 properties. Single family homes do not provide the same benefits that commercial properties provide. And I'm going to get into that in just a second. So we have commercial properties, different tax benefits, they have different economies of scale, different debt structure. And they're just different. They don't operate the same way that the single family homes operate. A lot of people actually start investing in single family and then move into commercial real estate soon after, once they realize what all the benefits of investing in commercial real estate are. But until then, single family, in my opinion, is right now the number one asset to look after. So if you can find ideally what you would want to do in the single family space is you would want to probably find a undervalued distressed type asset, so like a wedge deal, right? You'd want to find something that needs a little bit of TLC that you can put a little work in, and you would want to buy that and hold on to it at the next to nothing interest rate and rent that property out and make your mortgage payment. And in some time, refinance that property at market value, once it appraises for that, get your equity out and move on to the next deal. That is the fastest and best way to move in single family, right? You have to refinance, get your equity out, and move into the next deal. And these are, by the way, these are all strategies that are available for free online. If you look up single family investing strategies, this is one of the most common real estate investing strategies for single family that is out there. You refinance your first deal, you move on to the second one, then the third, then the fourth, by just refinancing. And once you refinance, I think you're allowed under the normal guidelines to buy up to 10 homes and get like a package loan on them. And that is still considered conventional. Once you exceed the 10 home limit, then there's other products that are a little different that you have to invest in. Invest in relationships and a little more, there's a little more complexity that goes into the loan. But those loans are also available to anybody who has more than 10 homes. I've also seen people invest in 10 homes, like if they're married as a couple, the husband buys 10 homes and the wife buys 10 homes. I don't know if that's a legal a way of doing it. I think it may not be, but I have seen that being done in the past. So once again, just to recap for those of you who have just joined, because I see a few more people in the room. So for those of you who have just joined, we were talking about single family homes and why single family is the one of the hottest commodity right now. And it's just, low interest rates and the pandemic. The pandemic has really helped a lot of people uh, realize that they need to move into houses because they can't stand being in such a small or such a close proximity with the rest of their family. And I know sometimes that is the case with me as well. I get overwhelmed while I'm working, so I can totally understand why people would want to buy, or why there's such high demand basically in single family space. With the single family space out of the way, right? I hope you guys got some good information on single family. I think I spent way too much time talking about single family. And with that being said, by the way, I don't specialize in single family at all. I'm not a broker. I'm not an agent. I don't invest in single family properties, but I have extensive knowledge because that is where I started out 6 years ago. Let's move on to another asset class. So I'm gonna start from what is in my mind weakest to strongest. I'm going to start with office and retail, because I believe that those are the two weakest asset classes right now. And people who are holding on to a lot of office or a lot of retail are going to be upside down fairly soon. And there's a few reasons for that, which I'm going to get into. So lucky for the single family guys, you have Fannie Mae and Freddie Mac, government subsidies. Your debt is very long term. It's secure. No one's coming after you. A lot of retail and office buildings were financed through the CMBS, which is the commercial-backed mortgage services. And most of this product currently is financed on bridge. And by bridge, I mean these are very short-term loans. They're a little higher risk. The thing about them is that people get into them for a short period of time and then either exit, meaning they either sell the property in that short period of time, or they add value to it. So like, let's say, for example, if you had a rundown office building, you came in, you put new elevators, you did new lobby, you got a reception, you got some security, you built the office corridors, you did doors, you made the office building a little better. CMBS is your best friend to do that. That is exactly what they are in place for. So what they do is they help people add value to properties and then refinance out of them into agency debt or bank debt. And that is really what CMBS is there for. Now, CMBS guidelines are very vague. And I will tell you this, when the pandemic hit, the first people who were crying were the CMBS guys. The CMBS guys had no idea where to go. And by CMBS guys, you can look it up, just Google CMBS loans. And you will find, and there will be an explanation on what CMBS is. What you need to understand is that CMBS is very risky debt, right? Regardless of the asset, CMBS has the ability to pull out on any loan at any time and for no good reason. So that's something that you guys need to understand as well. So the asset class, although very important, the debt structure is even more important than the asset class, because the debt structure is really what makes or breaks your deal. Oh, thank you. So like I said, the debt structure is really what ends up making or breaking your deal. And what you want to do is you want to be in a position where you are safe, where you are for the next 5 years, you don't really have to worry about your loans. And where we are in the cycle right now, CMBS debt is very scary. A bridge loan is very, very scary right now because, if things were to go south, which they are going south, your loan is in jeopardy. You are in jeopardy. These assets are going to be foreclosed upon. Right now, we haven't really seen too much foreclosure. We have seen some foreclosure, but we have not seen too much foreclosure. We've seen note swaps between agencies and like debt structure, but we have not seen too many foreclosures yet. But in the office space, especially in the office and the retail space, I do anticipate we are going to see a high number of foreclosures heading that way, especially for people who don't have holding power, especially for syndicators or funds who are very aggressive, investing very heavily. We are going to see uh, a record number of foreclosures as unemployment rises, which it will, just because there won't be enough stimulus or it won't come in time. Right now, stimulus is also something that is kind of being held up for debate and prolonged. The process is being prolonged. I think giving the people $1,200 was a joke. There are some people who really need more money than that, and the timeline that people got their money in is also a joke. I mean, if the government can do the things that it's doing, they can issue a $1,200 check to people who really need it quickly. But that check, for whatever reason, is getting delayed more and more over time. And I just don't understand why that is. I think people there's a lot of people out there who really need the money and they should get it. With that being said, uh, I think retail and office will go down first. Now, the one interesting thing I heard, and I've heard this multiple times, and you guys can correct me if I'm wrong, is that I have seen a lot of office conversions. So by conversions, I mean there's a lot of people who are taking old offices and converting them either to condos or to apartments where people can live, or to apartment buildings or micro apartments in urban dense areas. So like in very, very dense areas, I've heard of these cases where people are buying rundown office buildings and converting them to apartments and seeing good success with that. I don't think that will be the case here in Houston, Texas. I don't think that that is something that is viable. I think apartment buildings, I think that the residential space is still relatively cheap, which means it wouldn't make sense for somebody to buy an office building and convert it into apartments. I don't think it's economically feasible or viable in some metro cities. And Houston, Texas used to be the fourth, or I think still is the fourth largest metro economy in the US. I think we've dropped a few numbers as far as GDP, but I think we are still a very strong economy, and most of our business is driven through the oil and gas vertical. Anyways, so we covered single family homes. We are now moving on to office and retail. So I covered a little bit of office and why I think that the office space is really the first space that's going to take a hit, right? Let's think about this. The debt structure is difficult. Most people buy office on bridge loan or bridge type debt, which is risky in itself. It's short-term debt. It's meant to be moved on to long-term agency debt. But then again, a lot of people get stuck because of prepayment penalties and other types of penalties in the debt structure to where they can't move out of the asset unless it is, unless they bought it really under market and they can cover all their expenses when they're selling the asset. Now, I will also say that with more and more people moving remotely, I think I read an article somewhere today. Correct me if I'm wrong, guys. I think my TikTok guys have got me here. I read an article somewhere where Etsy is moving like 50% of its staff to remote, and what that means is that they just canceled, or they just did not renew one of their larger leases that they had somewhere in the US. I can't remember where it was exactly, so I don't want to say it on camera. But point being, office buildings are going to go down. There's going to be more vacancies. There's going to be less demand for office space as people choose to stay home, which is another reason why homes are homes are such a strong asset class right now. So retail, let's talk about retail, right? Retail has seen a sharp decline. We've had record number of bankruptcies from single tenant retailers. So you have your Macy's, you have your Dillard's, and I'm talking about Houston, Texas. So I mean, you guys can take this on a national level, of course. You've had very, very large retailers giving up space, and in some cases, that space is now being turned into Amazon distribution centers. That is another asset class that I would like to cover later on in today's video. Now, when you have a company like Macy's, or a company like, or a large company, let's just say, filing for bankruptcy, there's a lot of unemployment that comes with that. So, which means that there's a lot of people who are going to lose their jobs, and some of these people are only skilled at that type of job, meaning they don't have any other skills. What what's going to end up happening is that these people are going to fall for gig type work, which means they're going to be your Uber Eats people, they're going to be your Postmates guys, they're going to be your Uber, Lyft, right, or other such gig type businesses. So that could be either Upwork, Fiverr, right? It doesn't only have to be these things. But point being, when you have large retailers that lose that much footage, that means on a technical note, you have less demand, you have less people who are interested in renting, you have a lot of supply because you have the existing supply, plus you have the supply that has been building up, meaning the last few years of retail that has been coming in, right? And you just don't have enough demand. And if you were to walk into a mall, into any shopping mall today, what you're going to notice is that there are less people. People are social distancing, and the traffic count. There's always parking. You can always find parking, right? That's a very big indicator as to what the traffic is looking like. So a lot of people will tell you, yeah, the malls are kind of back to normal. Well, I guarantee you, if you go to the parking lot of those malls and just drive around a little bit, you will quickly realize that the malls are empty. I was in fact at a mall this morning, and it was relatively empty, and parking was right by the door, not a problem. Now, what I will tell you is that retail in the secondary and the tertiary markets, I actually see it improving. So not declining. Retail, um, you know, urban areas with higher, like the big box stores, I do see that going down. I do see that becoming uh, a less desirable product as people now are moving towards e-commerce, and even older folk who are not adjusting to buying online are now buying online. Now, suburban and tertiary retail, I do actually see that going up. I anticipate that suburban and tertiary retail, and tertiary is like rural area retail, actually going up, meaning people want to now be able to walk from their car directly into a store, whether that's a nail salon or a dry cleaners or a frozen yogurt shop. I think though that type of retail will actually increase in value. I think that type of retail is actually going to go up in the long run. So in the next 5 years, I think we will have a run on secondary and tertiary markets in the retail space, that we will see an increase in retail. And there's a fairly simple reason for that, right? The pandemic has kind of wired us in a way. I mean, we've been in this for about 6 months now, and I think even with the vaccine, we are going to be in this for another 6 months. So the pandemic has really taken our brains and reconfigured them in the short term. But this will continue even after the vaccine is here. This is still going to continue. People are still going to be used to a certain type of mindset. And so what's going to end up happening is that people are going to want to walk from their car into a shop, come back to their car, and leave. And for that reason, I think suburban retail will be really good. So any small strip centers with service businesses or product-based businesses will do fine. I think bank debt is king in retail. We have a lot of CMBS product, so which is risky, which is bridge, but we also in the secondary market, so in the suburbs, mainly all this retail is fairly new, and usually the way it's done is it's built ground up. As the homes come, the retail starts popping up. And what we're going to see is that this retail is going to be mainly, the debt on this retail is going to be mainly bank debt. Bank debt is a little more secure unless the bank goes bankrupt, which I don't think is going to happen. I think there's going to be enough stimulus or manipulation to kind of, to kind of go over that. But I do think that retail in the secondary markets will remain strong. Now, I think that's what is that? That's my dishwasher. I don't know what that is. Anyways, so I think retail will continue to remain strong in the secondary, tertiary markets, like I said. I think people are going to get sick and tired of staying at home, and they're going to want to do their dry cleaning to go to work, and they're going to want to, do their nails, and they're going to want to cut their hair, and they're going to want to do a bunch of things that is available in the retail space. So if you are thinking of investing in retail, please look into secondary markets, look into upcoming suburbs in your areas, which there will be a lot of, by the way. The home developers are gassing construction right now, just because so many people are looking to move into homes, and because the interest rates are so low. You want to look at upcoming suburbs, right? Not existing burbs. You want to look at the upcoming suburbs, and that is where you want to put your money in retail, if that is what you like investing in. And this is, once again, like I said, um, these are just my opinions. I'm just a guy on YouTube or Facebook or TikTok, so you can listen. I'm here to give you information just based off of my personal experience. Uh, but what you do with this information, you have to do very wisely. So retail, for those of you who are interested in retail, secondary markets, I would tell you that you'll be okay, regardless of what the news or the media is telling you. Yes, there will be job loss, of course. Yes, the unemployment rate will be higher, but then that is when you use strategies with your landlords, or that is when your tenants, or that is when the tenants use strategies with the landlord and kind of work things out. As long as the bank is not looking to foreclose, which they're not at the moment, by the way. The banks are absolutely not looking to foreclose on the assets. So the banks are working with all the landlords right now, via forbearance or not. There's a lot of banks that are not working forbearance, but have a way of working with the landlords in order to, depending on the relationship and the size of the business, of course, are working with landlords in order to kind of figure things out and push payments around, just so things work out easily. So that's retail. Uh, let's talk about hotels. I don't think I talk much about hotels in all my YouTube videos or my TikTok videos or on Facebook. And so let's talk about hotels. Hotels are in a very unique situation. I think hotels right now have a lot of distress, and I am seeing funds like Peachtree introduce distress funds, to where they're raising money, right? They're raising around, I don't know, let's say, just an example, they're raising $100 million to take over notes of distressed assets. And I think that's actually very, very smart. The fact that they're not going directly after the assets and they're going after the notes is an extremely ingenious technique, because if the hotel were to default on the note, guess what Peachtree could, or guess what any other fund could do that is interested in uh, acquiring hotels? They basically get the asset for nothing, and that's just because somebody defaulted on the note. So with the hotels, I am seeing a lot of distress, as occupancies drop, as social distancing is increasing. There's a lot of people who don't even want to get in elevators, uh, and don't want to share a common lobby or a gym or whatever it is, or a pool. Uh, there's a lot of people who are indifferent, who don't have a problem with that, but there's a lot of people who do. And so as a result, hotels are taking a beating. Now, the secondary, uh, the tertiary hotels, I think, are actually doing good. And what do I mean by tertiary? So the people now are driving way more than they used to, and are going to places by road way more than they used to. As you know, the airline business is down, and airlines are down as a whole, and people are not flying as much as they did. So a lot of people are going on road trips. A lot of people are driving around the country. And while they're driving, there's new markets, there's new hotels that have opened up just because of the amount of traffic that we're seeing on our roads. Uh, and so there's a lot of hotels on the highways that are open for business. And I think these hotels are the hotels that are doing well, just because these people need a place to stay overnight, so that they can continue with their road trip wherever they're going. If I was going from Houston to California, that's a 3-day trip with my family, right? So I need 2 nights of stay, and both those nights need to be at a hotel, and the hotel needs to be conveniently located on a highway. So I think hotels are distressed, but the best performing hotels are probably the hotels that are based in tertiary markets, and are based on highways or locations where people are transit visitors. So no longer destination hotels. I think destination hotels are really suffering, uh, But transit hotels are actually doing well because a lot of people are stopping there overnight, and they have to because they get tired, right? They have to take a break, recharge, and then move on the next day. So in the hotel space, I can tell you that what you're going to see is you're going to see a lot of movement in tertiary markets. Now, you will also, other than that, what you will notice is that there is a lot of distress in the hotel space, and that hotels are going to get foreclosed on. There's going to be a lot of hotels that are going to get foreclosed on just because there are funds now trying to take away that debt from the agencies and buy it over. And the reason they want to buy it over, by the way, is they are actually preying on these hotels and hoping that these hotels will miss a few payments so that they can foreclose on them. That is the entire reason that funds are going out after the notes and not after acquiring the actual asset. See, I think that's pretty genius, right? The fact that these people are going after the mortgages and buying those mortgages at a discounted rate from the banks, and the banks are like, you know what, we don't want them. Just take the loan away from us because this is a high risk asset. We are in a high risk uh, time now just because of the pandemic. You can go ahead and take this, and then these funds will go ahead and foreclose on those hotels. And what will end up happening is they've ended up foreclosing on the hotel for nothing. They've probably bought the hotel at 30, 20 cents on the dollar. And that is kind of what they're hoping for. And so if larger funds are doing this, I do see a lot of distress and a lot of panic in the hotel industry. Let's move on to another asset class. So we covered homes. Homes are very strong. Interest rates are low. Demand is high. Pandemic, people are about to kill each other in small confined spaces, so they need more spaces. So they're moving out to the burbs. That's hotels. Offices are a dying breed right now. They may come back sometime in the future, but as of right now, they're dying. Debt is very risky on offices, and the debt structure is difficult. Occupancy is low, and people are now choosing to work from home, which means, in my opinion, offices are going to go down. Then we covered retail. Retail is a great space if you're in the secondary market, which means if you're out in the burbs or if you're out in new and upcoming areas where people can drive from their car into your shop and then come back out. A shopping center, a mall, that type of thing. I do see a lot of distress in those markets. Then we talked about hotels. Hotels. Lenders are selling off their notes to funds. Funds will be very aggressive. What will end up happening is when the hotel misses a payment due to low occupancy or whatever, or mismanagement, what will end up happening is that the funds will foreclose on the hotels. All right. Now, those are from, in my opinion, weak to strong, right? Now let's get into multifamily. Multifamily is primarily where I invest. I have 11 communities. I manage just under 1,000 apartments here in Houston, Texas. I want to talk about what I think is going to happen in the multifamily space and what is currently happening in the multifamily space. So what's happening in the multifamily space right now is that occupancies are actually at record highs, right? So all my communities are at 95+% occupancy. The problem that we have, and this is a big problem that not a lot of people talk about, is that your collections to occupancy delta, there is a delta there, right? And that is about 10%. What does that mean? What does this 10% delta mean? The delta is basically your occupancy is at 95%, right? Or let's do this. Let's take an example to make things a little easier. Let's say you have 100-unit apartment community that is occupied 100%. So you have 100 families who live in that apartment community. What's ending up happening is that only 90% of the tenants are able to make rent. So you have a spread, and that spread is 10%, right? And that spread actually is huge because this is something that we've never had in the past, where 10% of the people of the population are just unable to pay rent directly as a result of COVID-19. So you're talking about either death in the family, illness in the family, unable to provide income due to sickness, or other family members getting sick, and these people cannot go to work because they have to take care of them. So these are real life situations. These are very, very stressful situations for people. And so what ends up happening is that you as a landlord or you as a fund end up having a spread. You may have 90% occupancy but 80% collections. Occupancy is a very deceiving number. It can be manipulated. which it often is. But in reality, there is a spread today in the market. Now, the other problems that we're looking at is that the cities, right, your local county is providing what they call rental assistance. Now, don't be fooled. Yes, rental assistance is there. It is available. I will tell you this firsthand that all of my 11 communities are part of a rental assistance program. But when your county comes out and says, hey, we are going to provide rental assistance for all your tenants, guess who ends up paying for that rental assistance via property tax, right? So what we ended up seeing in this year, in 2020, is that we did see an increase in rental assistance in each one of our properties. However, we also at the same time saw our property taxes rising. And property taxes rose anywhere from 20 to 100%. That's right. I'm saying 20 to 100%. And what happens is that we then, as landlords or investors or investments or funds, have to now litigate, have to go into litigation, which is very costly and time consuming. And so we're going to litigate with our county in each one of our communities. But what ends up happening is that that process takes 2 years. And in those 2 years, you have to continue to pay those taxes. So we have rental assistance and we're getting rental assistance, which is great for our tenants. I'm really glad that our tenants are getting rental assistance and are able to make pay, right? But at the same time, our taxes have risen more than what our rental assistance would cover. And so for that reason, we in the multifamily space actually are ending up with tighter spreads, and the margins are just really, really slim right now. And what ends up happening, because the margins are really slim, is that our valuations will go down. And that is the exact reason why our valuations will go down. Our valuations will go down just because taxes have gone up, which means our bottom line, so our top line is still good, but our bottom line now gets a little bit compressed. And when that happens, property prices do need to come down. The problem is that there is, again, a spread between your buyer and seller. The seller does not want to sell at a discount. The buyer does not want to buy at current market price, which is very typical in times of distress. So we are seeing less volume of transactions just because the buyer and seller are unable to meet at a price just based on what collections are. Now, I will tell you this. In March, April, May, June, and July, placing debt on multifamily was very difficult. And what that means is getting a loan for buying a multifamily asset was extremely, extremely difficult. And that meant transactions were just not happening, right? Both buyer and seller were just not able to come to a close. In fact, I had a deal under contract that I was selling at that time. I actually walked away with about, I want to say $50,000 of earnest money just because the buyer of that deal was unable to close on it. And no fault of his own, his lender just said, we can't close on your deal just because we are in uncharted territory and we don't know what's happening with this pandemic, which is totally understandable. I got to put 50 grand in my pocket. And it is what it is, I guess. At the same token, I will tell you this. When putting earnest money in multifamily, because multifamily is such a desired asset, it's usually hard money that goes in. So you have to be extremely careful. For those of you who are thinking of investing in multifamily, you have to be extremely careful, especially if it's your first deal. Do not put too much earnest money in that deal because you are not going to see that money come back to you. And that is something that is very, very important. Sorry, I just have a few questions that I'm going to get into. Short sale. Okay, so I will be answering the questions that I am receiving here. So just keep them coming, and I'm gonna scroll up and just get to them. Multifamily, people are staying at home 24/7, not going to the office, which means the multifamily assets are getting run down at double the rate that they were supposed to. Right. So when we build a multifamily apartment community, we anticipate that a person is going to spend 12 hours in the unit and 12 hours away from the unit, right? Working or doing whatever they are outside of the apartment. And so they're built that way, right? You have your appliances, you have like things that just are made at that capacity, are made to be used 12 hours a day, and then they are made not to be used other 12 hours a day. Right now, what's ending up happening is these apartments are getting run down. The water is just being utilized more, the sewer, the plumbing, the ACs, everything is just being utilized more and more, which means these apartments are essentially deteriorating at a faster pace than they were. Uh, this has this has posed a few interesting challenges, and at the same time has introduced a few interesting opportunities for us. And so you kind of need to take advantage of both those scenarios, right? You need to identify your weaknesses and at the same time improve on them, but you need to introduce new strengths now because people are just more in tuned and more into your apartment communities. Also, I will tell you this: customer service is very important, but in times like this, it becomes very challenging, it becomes very difficult. And the reason is that some people are just unemployed, and when they're unemployed and bored, there's going to be a lot of complaining about the community. This is just something that you have to learn to deal with, right? People are just going to keep complaining. Hey, there's a bug in the grass. Hey, there's this, hey, this little thing is scratched, or this little thing is not okay, and this is just things that we have to deal with and come to terms with as people spend more and more time in the apartment community. Now, the reason the apartment community will remain strong and the apartment, sorry, asset class, the multifamily asset class will remain strong is because of the debt structure, right? We have Fannie Mae and Freddie Mac providing debt, so providing the loans for these asset classes. And Fannie Mae and Freddie Mac right now are in a very strong situation. I think they learned their lesson from 2008 and 2009. So from the last real estate bubble, they have learned their lesson, and they are very, very well backed and very, very liquid, and their due diligence process is really on point with providing leverage on sound assets, which is what they do. This is going to be the ultimate driver for multifamily success. So we are going to see a lot of other asset classes trying to move into the multifamily space. And the reason is that Fannie Mae and Freddie Mac provide amazing debt structure. It is uncomparable with other debt structures. So I'm talking 30-year term as opposed to 20 or 25-year in other commercial real estate asset classes. You get exactly what you would for your home, which is insane, which means your mortgage payment is nothing, right? And also you have very interesting interest-only payment terms. You could get an interest-only from starting from 1 year to where you only pay interest, which is really nothing. And that could go up to 5 years. A lot of funds actually exit out of real estate. So listen to this. This is so interesting. A lot of funds will buy into a real estate asset and pay interest only until the day of exit. They will not pay down $1 of principal. They'll get a 5-year interest-only term and then exit the fund at interest-only rates, which is amazing, which is excellent. It's like, how do you even do that, right? But this is what is happening. I have personally done this in one exit. So I've had 3 full circles on my fund. And that, by full circle, I mean I have purchased, rehabbed, improved the value, sold, returned money to investors, and then kept the money, right? I've had 3 of those exits so far. I have 2 more on the way that have been slowed down due to the pandemic. But point being, I think the asset class is sound. I think Fannie Mae and Freddie Mac are doing a great job. I think even in the time of the pandemic, when we were looking at what the hell's going to go on? Are we going to foreclose? Are we going to go into forbearance? How is that going to work? Fannie Mae and Freddie Mac were the first lenders, I think, that I heard from that released clear guidelines on exactly what is going to happen in the real estate space. CMBS was literally nobody could get in touch with them. I have people who are heavily invested in retail and other commercial assets through CMBS crying, not being able to figure out what's going to happen. They're going to go into forbearance. The CMBS is going to foreclose on them. What's going to happen to the loan? Nobody really knew what was going to happen. And it was just a stressful time for the CMBS guys. Whereas the Fannie Freddie guys, which means the multifamily guys, were just hanging out because we had exact guidelines and we knew exactly what the process was going to be like. And if we needed forbearance, we knew exactly what that was going to look like as well. So I just want to be clear on one thing, right? The asset class. So some of you have asked me, what is your outlook on, like, for example, multifamily or retail or, whatever, industrial over the next 5 years? I will tell you that the asset class, although relevant, is not the most important thing right now that you guys should be thinking about. The thing that you guys need to be thinking about right now when investing in real estate is your debt structure, meaning the loan that you're going to get for that asset. That loan right now determines how sound your investment is or not. Because you could get a shady bridge loan or a high interest, like hard money type loan for commercial real estate, and that is not secure. And I would not recommend you do that. I would recommend whatever asset class you are investing in, please get either bank debt that is long term with a bank that you have an existing relationship with. So that means they're not going to foreclose on your ass as soon as things go south. They will hold out. Or if you are in the multifamily space, just use Fannie Mae and Freddie Mac, and that's it. Don't use anything else. If you are new to real estate and you want to do one of your first investments, please go single family with Fannie Mae or Freddie Mac, long term, 30-year. If you want to do a 15-year because you want to pay off things quicker, you can do that by all means. But I am a big fan of the 30-year, just cruise control type debt, to where we don't have issues. So I am actually based out of Houston, Texas. So I have vast amounts of knowledge of the state of Texas, and that is where I do most of my investing in. Uh, yeah, of course. So I have a question here that says, I think location will be a big key. Of course, location is very important. And hopefully when you buy these assets, you're only buying them in desired zip codes. So the way I usually do all my due diligence on a state where I invest is I look at the verticals, I look at unemployment, I look at crime, I look at education, there's a couple of things that I look at before I um, enter into real estate. And uh, if all those verticals or all those questions are green in my mind, then I go ahead and invest in those asset classes. Now there is one asset class that I've been promoting heavily over the past few months, and I want to talk about it here on the channel. And for those of you who are still here, I think this will be the most valuable piece of advice that I can give you. And so listen up, basically, is what I'm going to tell you guys. I think industrial real estate is going to be king. Now, remember, I am a multifamily guy. Okay. I used to invest in industrial a long time ago, 6 years ago. I have not touched any industrial assets in about that much time. I am mainly multifamily. I believe Fannie Freddie is the best debt out there. So I choose multifamily just for safety, security. But I think moving forward, industrial real estate is where everybody wants to be. And the reason is, with the rise of e-commerce, with the aging millennial and Gen X population, and the boomers now shopping online through apps via e-commerce, ordering clothes, makeup, just equipment. Things are just happening online, and things are just becoming more e-commerce based. And for that reason, I see a lot of private companies. So I'm not talking about Amazon distribution center type industrial. That will be great, but those are single tenant. I don't believe in single tenant. I think single tenant anything is very high risk, which is why I don't like which is why I don't like single family. I only invest in multi, because I like multi-tenant. And usually the profile is I would want at least 4 or 5 tenants in a property in a commercial deal. So I think industrial is going to do well. And there's two reasons for that. Industrial space are usually catered for service-based businesses. Like, let's say, for example, you have a lawnmower repair service. That lawnmower repair service needs industrial space. Uh, there is no substitute for that type of business, right? You have lawnmowers, you have grass. That grass grows. You have companies that come and cut it for you, whether it's in your office building or in your house or in your apartment community. Those lawnmowers are going to break, and when they break, there needs to be a service that fixes them, and that service can only be in an industrial business park, meaning they're going to have a small office. They may have a small showroom where they sell stuff, but they need a place to operate that business and fix those lawnmowers, and that space is mainly going to be industrial, right? Let's think about this. You have a car detailing facility slash car wrap facility, right? They need to wrap your vehicle into a different color. Let's say you drive a Lamborghini, right? And so now that Lamborghini needs to be purple. And in order to do that, you need to drop that somewhere, and that somewhere is going to be light industrial, and mainly it's going to be uh, you know in a space that is a business park that has other businesses like it. So I think for anybody who is interested in investing in real estate, look into industrial, multi-tenant industrial real estate. And remember, I'm telling you this, it's September of 2020. In 5 years, you will see the largest bull run in industrial real estate that you have ever seen, just because of the adoption of e-commerce and the ease of what e-commerce has done um, to boomers and millennials, right? You had Gen Z, of course, is completely online. They probably wouldn't enter a mall unless it was like an emergency and they needed something right away. Um, the millennials, however, especially the ones on the top, the ones who are like, borderline millennials, we're still resisting e-commerce, but that time has gone. And so I think I think that is really where people are going to thrive. That's really where people are going to make a lot of money. I also think that for industrial projects that are over 15 million, there is going to be a lot of institutional interest, meaning there's going to be a lot of Wall Street money that wants to move into these assets, just because there is no substitute for this type of product. Let's talk. So I talked about the positive and why I think industrial is so okay. I got a question here about industrial real estate stocks, and if you want to invest in industrial real estate stocks, so I'm going to give you a stock ticker symbol. And once again, this is just my opinion. I'm just a guy on a platform, right? So please don't hold me you need to understand your risk and how you're investing. But if you were to look and compare uh, every other asset class with the industrial space, and you wanted the ticker symbol to invest in industrial, which I think is really smart, that ticker symbol would be STAG, STAG. And if you compare STAG to Realty Income, which is like the go-to for real estate investing as a ticker symbol. So O, the ticker symbol O, and you compare STAG to O, I think STAG has actually outperformed O, which would tell you exactly what I'm telling you right now in simpler terms, right? That industrial real estate for the next few years is really going to be the number one asset to be in, which is why I personally have made the decision to move out of the multifamily space and move back into the industrial space, and continue to be in the industrial space for at least the next 5 years, because I see a massive bull run in that space. I think the industrial space is going to be absolutely phenomenal, and I think the tenants really have nowhere else to go. I also see a lot of retail tenants moving back into industrial spaces, so having a showroom and then having a service section. And these were people who in the past may have only had a showroom and then a space somewhere else. I do see a lot of consolidation as well. So you have a lot of businesses that'll have a showroom in a retail location, and then we'll have a storage facility somewhere else. And then there is, the delivery comes out of other places. I think these smaller businesses now are going to consolidate, and what's going to end up happening is that they're going to have both uh, the product and the showroom in the same location, just for ease and comfort, because I think as people move less and less and things go online, it'll just be easier for them to do everything in one space. They're not going to need a fancy huge major showroom. What they're going to need is they're just going to need a small spot where they can do a Zoom call and show the client what they need to see and then ship it right out. So I do see a lot of consolidation happening in the industrial space as well. So with that, I think I've covered most of the asset. I think I actually covered all the asset classes. I covered homes, which I think are in high demand. I covered offices, which I think are going to suffer just because of the debt structure on what offices are, uh, what kind of loan these office people take. Retail, you want to be in secondary and tertiary retail. Hotels, you only want to be on the highways, on on hotspots across the US. I think metro hotels will suffer just as travel and things become less. Destination hotels will be horrible because nobody is really going anywhere. So you want to be in the transit hotel space. If you guys are interested in investing in hotel stocks, that is what you need to really look at. Um, Multifamily will be okay. We have challenges. It's going to be an uphill battle, but I think all in all, multifamily is safe just because of the debt structure, and Fannie Mae and Freddie Mac are fairly strong with that. So I think we should be fine. Industrial will be king, in my opinion. And that is really all I have to say in this video. I hope you guys enjoyed this video, and I look forward to making more videos. If you guys are interested in me making videos with a little more data, I can put together a slide. I can put together a PowerPoint and make more informative videos with data. Obviously, I'm generating all this information in my mind from data that I have seen, or from data that I have created, or from analysis that I have done in the past. But of course, um, I would be more than happy to share and create something and share that with you guys if there is any interest in the future. And with that, I will see you guys next video.